You've been lied to about what money is. Not in some conspiracy theory way, in a much simpler, more boring way. The dollars in your bank account aren't actually what you think they are. They're not really money. They're promises, IOUs, digital markers of debt that only work because everyone pretends they're real. Here's the uncomfortable part. The entire modern economy runs on this illusion. And the people who understand this illusion best aren't spending money, they're creating debt. Let me show you what I mean. In 2008, the global financial system almost collapsed. You probably know that. What you might not know is what actually broke. It wasn't that people ran out of money, it's that they stopped trusting debt. Banks wouldn't lend to other banks. Businesses couldn't borrow to make payroll. The machine seized up, not because there was no currency, but because the currency itself is debt, and suddenly no one believed in it anymore. The Federal Reserve's response was telling. They didn't drop bags of cash from helicopters. They created $9 trillion of new debt. They bought bonds, mortgage securities, treasury notes, all debt instruments. Because that's what central banks actually do. They don't make money. They make debt, and then they call it money. This isn't a bug, it's the design. Let's rewind to understand how we got here. For most of human history, money was a thing. Gold, silver, shells, cigarettes in prison. Something scarce that people agreed had value. If you wanted more money, you had to find more of the thing, dig deeper, trade harder. The supply was limited by physical reality. That changed in 1971. Richard Nixon did something that still echoes through every transaction you make today. He ended the gold standard. Suddenly, the dollar wasn't backed by anything except the promise that the U.S. government would accept it for taxes and debts. It became what economists call fiat currency, money by decree, money because we said so. But here's where it gets interesting. Once money isn't tied to anything physical, how do you create more of it? You can't mine it or grow it. You create it through debt. When a bank gives you a mortgage, they don't take money from depositors and hand it to you. They create new money out of nothing in the form of a loan. You sign a contract promising to pay back $300,000 over 30 years. The bank credits your account with $300,000 that didn't exist 30 seconds ago. Then you give it to the home seller, who deposits it, and now it's part of the money supply. Debt created currency, not the other way around. The numbers reveal how deep this goes. As of 2024, global debt hit $307 trillion. That's 307 followed by 12 zeros. Global GDP, the actual stuff we make and do, is around $105 trillion. So we owe 3 times more than the entire planet produces in a year. Here's the absurd part. That ratio keeps growing. In 1970, before Nixon's decision, global debt was roughly equal to global GDP. Now it's triple. And that's not a crisis. That's the system working as intended. The U.S. federal debt alone is $35 trillion. Household debt is $18 trillion. Corporate debt is $13 trillion. Student loans, credit cards, car payments, mortgages, it's all debt. And every dollar of that debt is simultaneously someone's asset. Your mortgage is a bank's asset. Treasury bonds are pension funds' assets. The economy doesn't run on money. It runs on the spread between what's owed and what's owned. Now think about what this means for how power actually works. If debt is the real currency, then the people who can create debt are the most powerful. Not the people who earn money, not even the people who have money, the people who can borrow the most at the best rates with the least consequences. Governments can borrow trillions and never pay it back. They just roll it over, issue new bonds to pay old bonds. As long as people believe they'll keep doing that forever, it works. Corporations can borrow billions to buy back their own stock, making executives rich without creating anything new. Real estate developers can borrow against properties they don't even own yet. Meanwhile, regular people borrow for school, for medical bills, for a used car, and they actually have to pay it back, with interest. The system allows infinite debt for those who need it least and punishing debt for everyone else. That's not an accident, it's the feature. Here's where the tension lives. The system requires more debt every year to function. Economic growth in a debt-based system isn't about making better products or working smarter. It's about borrowing more than you did last year. If total debt stops growing, the economy shrinks. Not because people are lazy, because debt is how money enters the system. But debt has a ceiling. Eventually, you can't borrow more. You're tapped out. Rates go up. Defaults spike. Then the central bank steps in and creates new debt to paper over the old debt. The cycle repeats, bigger each time. Japan has been trying to escape this cycle for 30 years. Their debt to GDP ratio is 260%. They've bought so many of their own bonds that the Bank of Japan owns half the country's government debt. They've tried negative interest rates, paid people to borrow money, and still the economy barely grows. Because once you're deep enough in the debt trap, growth itself becomes the problem. Growth means more debt. More debt means more fragility. Europe is walking the same path. China is sprinting down it, with local government debt hidden in shadow banks and state-owned enterprises that no one can fully audit. Even the phrase debt ceiling in the US is a joke. We raise it every time we hit it, because we have to. The alternative is admitting the system doesn't work without infinite expansion. Let's zoom out to the individual level. You probably carry debt. Most people do. Credit cards, student loans, a car note, maybe a mortgage. You were told that's normal, even smart. Leverage your future income, build credit. The American dream is financed, not earned. And in a debt-based system, that's true. If everyone else is borrowing to get ahead and prices inflate because of all that borrowed money, then not borrowing means falling behind. You're playing the game by the actual rules. The problem is the rules themselves. Because here's the trick. Inflation, the slow erosion of what a dollar can buy, is a feature of debt-based currency. When you create money by lending it into existence, you're increasing the supply. More dollars chasing the same goods. Prices rise. Your paycheck buys less, but your debt stays the same size, which means inflation helps borrowers and punishes savers. That's why central banks target 2% inflation, not zero, not deflation, 2%. Just enough to make sure that holding cash loses value, so you have to invest it, borrow against it, keep it moving through the debt machine. Stillness is death in this system. Now here's the uncomfortable question no one wants to ask. What happens if people stop believing? Not in some dramatic bank run way, just slowly, gradually. What if people stop believing that 30-year Treasury bonds are safe? What if foreign governments stop buying U.S. debt because they don't trust the currency anymore? What if the next generation decides they won't take on 6 figures of student debt because the math doesn't work? The system doesn't collapse from too much debt. It collapses from too little trust. And trust is a funny thing. It's infinite until it isn't. It's unshakable until everyone else realizes everyone else is pretending too. We almost saw this in 2008. We're seeing glimpses of it now with bank failures, pension shortfalls, sovereign debt crises in smaller countries. Each time central banks step in with more debt, more liquidity, more promises, and each time the amount required to keep the illusion going gets larger. There's a phrase you hear in finance. Debt is future consumption pulled forward. You're borrowing from tomorrow to spend today. That works if tomorrow is richer than today, if the economy grows, if incomes rise, if the bet pays off. But we've been pulling forward for 50 years. At some point, tomorrow arrives, and it's not richer. It's poorer, because all that consumption was borrowed, not earned. The bill comes due, not all at once, slowly, in stagnant wages, in inflated asset prices that lock out new buyers, in the quiet realization that your parents' generation had it easier, not because they worked harder, but because they got to borrow when debt was cheap and consequences were distant. You can't escape this individually.
You can be smart about your own debt, pay it down, avoid bad loans, but you're swimming in an ocean of everyone else's debt. It sets the price of your house, your groceries, your education, the interest rate on your savings account. You're in the system, whether you like it or not. So what's the answer? That's the thing. There might not be one, not a clean one. The system is too big to unwind without breaking everything. You can't just cancel $300 trillion of debt. That's $300 trillion of assets, pensions, retirement accounts, savings. Someone's debt is always someone's wealth. The most likely path is that we keep going, keep borrowing, keep pretending, keep inflating the currency just enough to make old debt manageable while creating new debt to keep the machine running. Until we can't. Until trust breaks.